Good morning, everybody. We will be starting here momentarily. Just need about one more minute for everybody to join. Looking forward to talking to you today. All right, let's get started here. Well, hello, everybody. It's May 2024. We are excited to bring you another webinar, another monthly webinar. We were just talking today. We've been the second year now, starting our third year of doing this webinar. And again, at the end of the thing, any feedback you can provide to let us know how we can improve it. Any questions you have, feel free to send them out in the questions in the portal, I guess you should call it. I don't know. But anyways, today we're going to discuss many things here today. Again, my name is Scott Ebeling. I'm Director of Pricing and Strategic Solutions. With me is Ali Kobalay, our Manager of the Pricing and Strategic Solutions team. And today we are going to be talking about Box. As always, that'll be Ali talking about it. I'll be giving a market update. And then we're going to be discussing here pricing strategies for large customers. So with that being said, I'll let Ali take it away. And she is for all the newbies and anybody else who is kind of new. We can learn about Box and everything that we have to offer and new and exciting things. Go ahead, Ali.
Awesome. Thank you, Scott. Good morning, everybody. Thank you so much for making time in your Wednesday for us. We really like doing these webinars, and like Scott said, we've been doing them for a couple years now, so it's super exciting that we're keeping it rolling. For those of you who haven't signed up with Box yet, maybe you haven't done business with us yet, or you're just looking into different ways to diversify your revenue streams or looking at bringing on a partner, Broker Online Exchange is the ultimate commercial energy brokering partner. We provide independent energy brokers and affiliates with access to all top electricity and national gas suppliers nationwide, instant pricing, and cutting-edge software, all supported by a team of industry experts, Scott and myself included. Broker Online Exchange has become the largest network of energy agents, brokers, and consulting firms in North America. We connect a variety of diverse energy partners so each can benefit from streamlined, efficient options in deregulated gas and electricity. You can see how you can scale your energy business nationally with our deregulated energy map, which is what we have up for you guys right here. You'll see natural gas only markets available in green, both power and gas markets available in blue, and then you'll see a good amount of states throughout the Midwest and the West that have some limited availability. Those states usually are limited availability states because it's only very large commercial and industrial users on the natural gas side that are able to shop. But the thing is, all of the lower 48 is deregulated whenever it comes to natural gas. It just depends on the degree to which states are allowing choice programs. And if a user is big enough in one of these areas, then they have the option to shop. So let us know if you're interested in scaling your business, if you're interested, if you've only ever sold power before and you're interested in getting into natural gas, whether that's choice markets or some of these larger commercial industrial markets. We're happy to help. One of the ways that we help you guys to penetrate these markets is via our supplier portfolio, which is on our next slide here. We partner with all of the big names in energy, so you'll see a lot of names up here that you recognize: Direct Energy, NRG, Constellation, Cero, and Champion. All of those guys have national reach. We also partner with smaller energy suppliers that either specialize in the mass market and choice space or provide really niche expertise whenever it comes to their specific market. A couple of those guys are on this as well. We will be featuring and talking a little bit more about Dynegy specifically later, but APG&E is on here too. Those guys are very strong in Texas right now. Freepoint, again, has national reach. So you'll see a lot of names up here that you recognize, but we partner with 90+ suppliers. So that would be a very crowded slide. If you're looking to bring on additional partners to present your customers with additional options, supplier options, product options, any of those pieces, we are here for you guys to do that. We have wonderful relationships across the industry. Most of our executive management comes from the supplier side. And so we are happy to put those relationships and all of that wonderful productivity to work for you. The last piece we'll hit on here is our strategic solutions team, led by Scott and helped by myself. We are here to allow every partner to really become a full service consultant. Buying electricity can be really complex, and with complexity comes the possibility of customers signing contracts that don't include what they anticipated. Our goal is to make sure that the customer gets both the best deal and the best contract terms possible in the marketplace, even if that's not necessarily the lowest price. And we'll go through that in a little bit, but as far as our strategic team is concerned, we're dealing with larger customers. We're proposing strategic procurement solutions, a disciplined hedging strategy. Scott will go over part of that later too. But we're creating products that perform well for customers. Energy is far from being a one-size-fits-all game. This is something that can get really complicated, and because of our relationships, because of our industry expertise, and because this is really truly what we love to do, we really love to help customers navigate these types of challenges. We offer all of these to support you and to better support your customers, to better serve your customers. If you guys are interested in any of this, you guys want to chat with us about it, reach out to your account manager or reach out to Scott or myself. We're always happy to talk about it. And to do more of that, I'm going to pass it over to Scott so he can give us our market update.
Thanks, Ali. Appreciate it. We might have to make this a nine pictures on here. We have more and more services that we offer here shortly. So anyways, I'm going to go into the market update, and we're going to go right into the headline story here for the month, and that was, of course, the ERCOT demand growth. There's multiple things that have been shown on this. I tried to simplify, really simplify this in one picture for y'all, and it's this: ERCOT load forecast for 2030. This is in gigawatts. Right now, just current, I probably should put that on here, currently, the current load, peak load, and this is peak summer load, is around 84, 85 gigawatts. The load forecast back in December was 112 gigawatts. And now in April, they moved it up to 152. And bam, of course, prices took off, 40 gigawatt thing. The reason for this was last year, Texas Bill 5066, they authorized ERCOT to include prospective load into its long-term load forecast. This caused an immediate 40 gigawatt increase in load forecast. So what that means in all simplicity is that previously, for December 2023 load forecast for 2030 was last December to do a load forecast twice a year. That was using it based off of things that were already planned to be connected, already been planned. So they now have prospective load and a rosy projection of course, we've all seen the headlines. We've discussed it now on here multiple times about the data center load, the wave of it coming online. And so now they're kind of forecasting that load. I think it's quite bullish, the size of it, and we get to that more a little bit later, but that's it. But the flip side of this too, and the story that really isn't being told as much is, great, there's new load, but here's a generation queue. And again, this doesn't mean all these are going to be online. Of course, there's issues with transmission. FERC just came out with a ruling yesterday to kind of hopefully make it easier to get these things connected on transmission lines and transmission projects get done. Which I'm still dissecting, by the way, we'll be discussing some more here today. But anyways, we have 155 gigawatts of solar in the queue, and that's peak capacity of that. So you know, there's a different capacity factors for much less. Wind at 35, gas at 15, battery storage at 141. The battery storage is awesome. So anyways, that's the queue. We probably need more thermal, which is more gas, and I think ERCOT definitely recognizes that. But this generation coming online, it's coming in here, and so we expect that. But here's, the other question too is, will data centers become more efficient? I've been talking about this. I've been starting to see some more chatter on it, especially from, one of my trading heroes, John Arnold, who was one of the founders of one of the better natural gas power traders out there, and he's kind of noticing this as well now. He's retired now, but he's a policy nonprofit policy group. But this is true here, and this is what I looked at. And NVIDIA is the big provider of a lot of the chips for these, and they now have they announced a platform coming out with 25 less cost and energy consumption than its predecessor. That's huge. So what's not being factored in is you're factoring in these data centers and the usage based off of current levels of power use by these chips in the mining and all this stuff. And I think that's going to increase and become better, as it always does, because costs bring down everything, and money's being thrown into this, and there's money to be made. It will usually get developed and it will come through. So I don't think we're going to hit those numbers. PJM's coming out utilization a little bit, but here we are. Here's the price update, and bam, you'll see the second line there on ERCOT, up $4 in 2025, $6 in 2026, $8 in 2027. We were in what was called a backwardated market for up until this month, which means the prices drop as the curve goes on. So as the years go on, 27, 28, 29, it becomes less pricey. What has happened is that now this is flip-flopped, and now the backward years are more expensive than the front years. And you'll probably see this in your pricing. Wow, pricing is up. Wow, pricing is way up, way up, way up. And this is why. And this is a great way to hopefully educate you guys and educate the customers of what's going on here. So yeah, pricing really dramatically gone up. The most volatile, one of the first times in my career in these markets of 25 years of electricity markets, and the back years are the most volatile area. I've never seen that before. Starting to wane a little bit, and you'll see in PJM there, they were down $2-3. Gas hardly moved. So this is heat rates declining or increasing in ERCOT, and you'll see there in PJM and ComEd, Ameren, and those markets are fading now a little bit from the demand thing that really much kicked up the markets at the beginning of the year. And last month they started declining a little bit from those, bringing them back down to back down to earth a little bit. I expect the same thing to happen in ERCOT, to be honest with you. That being said, you should always have a strategy. We'll talk about that and be constant with disciplined head strategy on it. But I wouldn't necessarily be backing up the truck here in the later years. But that's my opinion there. That's what's going on. And here's the prices as well. You'll see them here. And getting the slide decks in the portal there. Low volatility in term gas. This is winter 2025. Same trend chart theme for 25, 26 gas. It's not moving. We didn't expect it to move. It's doing the same thing it did last year. It's just basically saying, hey, we're storage is pretty solid. Nothing to see here. We're not really moving. Yes, the front's moved a little bit, but the back really hasn't at all. And with that, here's index pricing, ERCOT, again, just flat, nothing really going on here. Last 12 months, 54.72. And if you take out that August, we're in the upper 30s for last 12 months. We normalized that last August. But yeah, 5-year average 47.87, and here's the forward curve. So you see they're kind of elevated a little bit, especially because that 5-year average in power gas is about where it is for 2025 right now. The 5-year average gas price is equivalent to where the gas price is right now. As you see, the power price is up $7 or $8 compared to where the heat rates much larger compared to what it is. But and really the same thing you'll see in PJM here. It's even more to extreme actually. Same thing. Index price is down pretty low. Last 12 months now, $32 in PJM. Last 5 years, 38, but here's the forward curves. These have come off a little bit, but still pretty pricey. Again, compare 2025 to 5-year average, and because gas is the same, and we're kind of over, you know, definitely got some froth in the prices. I'll put it that way. Looking at it. 4 interesting slides here. Moving on. Wind generation. Wow. Who would have known this? This is a great little, you know, people never would have thought this, but it actually declined. The generation actually declined in 2023 compared to 2022. First times since really it's really been measured. And since windmills are just a little, you know, decorative piece on some of these farms, now they're all over the landscape. But yeah, this is a decline. But I want to preempt this, say something here as well. There is actually more capacity. It's just the fact that the wind didn't blow as much last year. So when normalized 2022, we'd have probably be in this kind of area. But it is starting, the increase is starting to slightly decline a little bit. I think we have a lot of wind here. Wind is not a necessarily on peak sort of source of power. It's definitely harder to predict. And as solar, his costs have come down, I think that's where more renewable assets are headed to. And going back to the ERCOT slide again, that you saw that. That's what's in the queue is the solar. Going gas storage. Different look at this time. We are taking a little different look on this, and so everybody take a quick second to look. This is every year for the past you know, 5 years plus this current year. And you'll just kind of see where we're at compared to that. So we're well above the highs of the last 5 years, or on it, well above the lows, you'll see. So basically, we're here just 2,600. If we ebb on this same trend of 2020, you know, we probably are going to be around this 4 TCF. But there's some things going on. I actually, and you'll see this, I actually think we're probably in about 3.8, 3.9, which is still extremely healthy storage. And this is what is really keeping gas prices down, keeping volatility low for 2025. One, LNG export growth. This is demand increasing. You'll see it here. We've talked about this ad nauseum. This chart's all over. Everybody's talking about it. But yeah, LNG export growth is growing, even despite the fact there's no new projects being allowed right now, although that's in courts. These are all projects that have been under construction. Some are starting up already. But yeah, we're going to have probably in the next 2 years, probably a 8 BCF a day increase in demand from LNG exports. And then natural gas power demand. This is increasing year over year. It's an interesting chart here. This is the average natural gas generation, our dispatch. So more and more gas generation is coming online as well and being dispatched, you know, more and more as well during the days is the choice of power, especially as the prices have come off. Producers drawing less. This rig count now is about ready to plunge below 100. We were at 158 last year. That's a extremely large decline of by over almost 40%. And with that, of course, now we're starting to see the lag of it. So it was a 6 to 9 month lag on when the production actually decreases, and now we're here. We're just actually now a pretty sustained year-over-year decline. We've had blips of this before, where there's been kind of like freeze-offs. But really the first time I've seen this in a while, we're now sustained at least 2 months in a row where the year-over-year decline in natural gas production, which is extremely interesting. CapEx is going lower, but with that, they're always increasing is a decent chunk of capped wells. So they're drilling somewhat. Some of these wells are being capped, but yeah, this isn't sustainable. Obviously we've just showed a 10 BCF increase a day or 8 BCF a day for next 2 years in natural gas for exports. We probably have a couple more BCF a day gas increase over the next few years in natural gas production. And just to stay equal, we're going to have to be higher. We're going to have to really get drilling here, but the price is going to be an indicator of that. and that will be dictating whether or not we'll get drilling going on. So with all that being said, and we're going to a little bit later in strategies, but I think it's so important to have a strategy. Here you see this is a chart showing the next 12 months of gas versus below is the reward, and the risk above where prices could go. It's important to have a strategy, be disciplined. Customers, remember, they're not taking a long position in the market, they're taking a short position. You know, long, short, just define that. We've had that question before. Long is always a meaning that you're in a commodity, you're buying it, and it's a speculation position, right? You're buying it, you're getting long it, you think it's going to go higher, so you get long the commodity. Customers are never in that position when they're buying. What they're actually doing is just covering what's called a short position, meaning that they're short the market, meaning they need it to they'll need to buy eventually to cover their position. And if you look at this chart, it's not a safe place to be in this very volatile market, especially near the lows, to be short the market. So if you expect to be in business through 2030, for instance, and you don't have power covered, load covered for 25 through 30, you're short the market there. And with that, I will move back to Allie. Thanks, Allie. And she'll go over some pricing strategies for large customers. Go ahead, Allie.
Awesome, thank you, Scott. We'll kick it off on pricing strategies for large customers. I just wanted to bring up a couple slides from our last webinar, actually. This is a little bit of a continuation of this large customer series. We've actually done quite a few webinars revolving around larger customers, their needs, where they are, how to approach them. So these are two that we actually looked at last time, but just in case you didn't get to tune in, big deals really do move the needle. This is an overview, it's just a snapshot of our numbers from 2023, but you can see our percentage of custom contracts being custom contracts that had to have a custom price, usually are using more than 1 million kilowatt hours a year, versus matrix customers who use under that 1 million kilowatt hours threshold. We closed 90%, just in terms of the actual number of contracts closed. 90% of those contracts were matrix contracts and 10% were custom contracts. Compare that to the revenue chart on the other side, and you'll see that those 10% of the contracts, that all of them that we signed last year, that 10% accounted for 53% of our revenue. And those 90%, that matrix number that, you know, we had so many more, only accounted for 47% of our revenue, which is a really healthy split, actually. I like these stats, but it really does show you how much more these custom deals can be worth. And with larger customers comes larger opportunities, comes more pricing options. And so that's a little bit of what we'll talk about today. The other piece that I wanted to go over just in terms of large customers is remember where they are, remember who they are, remember the industries that they're in. We're talking about commercial real estate, we're talking about data centers, manufacturing and industrial, education and healthcare, and franchises and chains. Each one of these guys have different priorities in terms of their budgets, in terms of their costs. Each one of them has a little bit of a different risk tolerance. So it's very important that you get to know your customer. I think we actually did a webinar on how to prepare for your first meeting with a big customer, going through different documents, going through all of the different data gathering, some good questions to ask them to get that conversation started and establish better rapport and establish credibility with yourself and your customers. But these guys are going to be your audience whenever you're talking about these larger customers and these larger products. So now that we've gone over these larger customers, who they are and how they can move the needle, the important thing to know about these larger customers is that they have options whenever it comes to their products. Everybody is familiar with a fixed all-in price, supply price. Maybe it includes taxes, maybe it doesn't, but it's one price per month, no matter how much you're using, no matter what season it is, it's always going to be a dependable fixed price. Everybody understands that, and everybody understands the utility variable that basically steps in if you don't select electricity supplier to be able to fix your pricing. That utility rate will go up and down. Sometimes it's served by a retailer in markets like Texas, where we have provider of last resort rather than the actual utility providing a default energy supply. But the important thing is that basically everybody understands a fixed price. And you'll see in the column furthest to the left, we basically have a fixed all-in price that fixes all of your components. It fixes energy, it fixes these other components like losses, capacity, transmission, renewable portfolio standards, ancillaries, and of course your broker fee is in most cases going to be a fixed dollar amount per kilowatt hour or megawatt hour. But those products and actually fixing every single component may or may not be to your customer's benefit. Some of these customers, whether they're in commercial real estate or whether they're in manufacturing and industrial or data centers, maybe have a different focus than fixing and stabilizing their budget. It's totally realistic that one of these customers could just want the absolute lowest per kilowatt hour price. They don't want to take on any exposure. They just want to be able to move with the market. They want to see that real-time price. And there's not necessarily a benefit to them to fixing all of their energy or completely fixing their capacity rather than passing it through. Sometimes you see this with customers who are undergoing changes with their load, whether they're decreasing the size of their facility or building on a new wing. Sometimes you'll see it if customers are moving from one location to another, but sometimes these are very old facilities who may have gone through an LED retrofit or an HVAC retrofit, and maybe a different component treatment would actually benefit them. Think about it this way. Whenever you're thinking about a small, medium business customer, just one single franchise, a matrix customer who's maybe using 30,000 total kilowatt hours a year, the premium or the additional cost to actually fix all of those components to protect them from a price spike, to protect them from paying an above market rate with a retailer, probably equates to maybe $5 a month, $10 a month, maybe even $30 a month. But it's probably worth it to that customer so that there's no surprises. They can set it, they can forget it, and they can put it aside. Larger customers in the manufacturing and industrial sector specifically will pay high premiums for those fixed costs when they're going to be paying tens, if not hundreds of thousands of dollars for their energy spend anyway. And focus really needs to be on creating transparency with that number and getting that number as low as possible. Because regardless of whether they're paying a 10.2 or a 10.9, fixing at that 10.9 is a sizable premium to that customer. That could be hundreds of thousands of dollars for them in spend that they don't necessarily need if they don't need that protection. Now, there's a lot of options in terms of the ways that customers can hedge, the ways that customers can protect themselves, and the ways we can structure these products to benefit them, whether that's passing through energy in a market where we know that energy is going to be low and we have a customer with a high risk tolerance, or whether it's fixing everything but capacity and transmission, whether it's fixing partial energy. The larger the customer, the more sophisticated options they have available to them. So that's what we'll get into here in these next couple slides. For your medium business segment, we actually have a product where customers can fix part and flip part. This is a great option for any of your customers that are in that 1,000 to 5,000 megawatt hour a year range, or 1 to 5 million kilowatt hours. They're not a massive user, but they're too big for Matrix, and they're probably too big for a totally fixed price to make sense for them, especially in some markets like ERCOT, where fixed premiums are just getting bigger and bigger and bigger. And there may still be an attractive piece on the index if you're floating off peak, for example. But these smaller customers, this is a great option for anybody who's rolling off of say they fixed during the pandemic and they signed a long-term contract and they're rolling off of a 3-cent all-in supply price. Things have changed. Things have changed since the pandemic. Things have changed since Uri. We have fundamental dynamic changes that are happening in this industry nationwide. and a way to help mitigate that sticker shock for customers and maybe actually capitalize on what actual energy pricing is doing in their location is to split the difference. Give the customer a fixed price for part of their load and let them fix and let them float a part of their load. This is a great move for customers, like I said, in that 1 to 5 million range, who, like I said, they have a little bit of backbone. They don't necessarily need to pay fixed premiums or get all the way to a fixed price, because there's a value proposition for them taking on even 10% of that risk. This chart shows about 50-50, but we have suppliers who can lock these amounts in increments of 10. So if your customer is saying, well, hey, I don't want to sign because the market's too high. Listen, I completely understand it's looking higher than it's been in a while, but that doesn't mean it's going to go down. The upside risk, like we've talked about, is so much more significant than waiting and trying to call the bottom of the market, which, by the way, we can figure that out. We can figure out the best times for your customer to transact, times when historically the market slumps, either after a holiday or during a shoulder season. But the thing is, the price may not go lower. So this is a great move for your customer who says, well, I don't want to miss my opportunity. But if pricing goes lower, then, what do? I'm stuck. I signed the top of the market. Mr. Customer, not a problem. We can provide you with a product that fixes half at current rates and lets you float half, giving you the opportunity to transact again should the market come down at a lower price, effectively splitting the difference and splitting that risk. The customer is happy because they have that floating position out there, which could result in a lower index energy price. We'll just be completely transparent. And they have hedged some of their risk. They've hedged half of it. And this is really easy. It's not that complicated a strategy or that different of a product than your fixed all-in rate. It's just floating a part of the energy and allowing the customer to reap the benefit of being able to transact more than once in the market over different periods of time. For larger customers, we can get a little fancier with this. They're eligible for more complex products, whether that's a index-based market product that is just floating 24/7 round the clock, March, April, and May through your shoulder seasons, whether it's fixing on peak energy only. You can do that year round, or you can do it for some months. Or you can actually effectively achieve a fixed price by layering these hedges one over the other, transacting every 3 months, every 6 months, every year, to make sure that you're protecting yourself for the next year. By managing and timing these transactions more strategically, looking specifically at the quantities that the customer has, and building a product really truly around not only their usage profile, but also their risk tolerance, we're able to actually deliver a product that performs better for the customer. It's a win for our supplier, it's a win for us, and it's absolutely a win for you as their energy consultant, because you recommended this wonderful thing and they don't have to think about it anymore. They get the benefits of being on a more complex product and actually having that performance, keeping their costs down, understanding what's happening with their product without actually having to do all of the work to manage that product, because we'll take that. We'll take on that work. We're happy to help. So for large customers, they really do have all of those options available to them. I wanted to bring up that, to show that product component treatment again. I think that's a great little graphic. These strategies for larger customers. This large customer slide is really more for over 5,000 megawatt hours a year, 5 million kilowatt hours a year. But if you're looking to do a simple 50-50 or a simple load following block and index for the entirety of a contract term, that's also something that we can do for that smaller customer set, for a medium customer set. It does require custom pricing. These products are not going to be available via Matrix ever, but we're happy to custom price customers if it helps them get to a place where they have a product that they're comfortable with, that they like, and that performs well for them. Last piece we wanted to hit on here is just going over how different customers can be one to another. So understanding both in terms of the customers and in terms of the products that you're pitching, even if it is a mainly apples to apples product from one supplier to another, we may have some component differences, and understanding which components are fixed and included in the contract price and which are excluded is absolutely critical. For those that are fixed or included, how are those components treated? Are they fixed through the term of the contract? Can they be adjusted via change in law language? Will they be adjusted bilaterally, annually, or will they be trued up monthly? Each of those scenarios is a fixed product. And so understanding your component treatments and what is in and out of that contract price is paramount to helping your customer make those decisions. We talked about buyer beware. Even if a component is listed as fixed, suppliers may still be able to make adjustments midterm, depending on the contract language. This is actually getting to be more and more of an offering. We're seeing more and more suppliers come out with a fixed adaptable product that is fixed to the best of their knowledge, fixed to all known values, market dynamics, capacity, auctions, etc., but can be adjusted if and when items change, if and when costs change. So it's very important that you help your customer understand, hey, even if this is a absolutely fully fixed product, we may see an adjustment. And if there is an adjustment, I will be the one who is on top of that. We will be doing our due diligence to make sure that that adjustment actually makes sense, and making sure that we're vetting, are you adjusting all customers? Are you just adjusting this one? Items like that. Again, we've negotiated contract language, and specifically around these larger customer sets, that's a huge value proposition for them, because everybody who works in legal still may not have the industry expertise to be able to make sense of some of the language in these documents. And we're happy to sit side by side with the customer and talk them through it so that they really understand. And again, even if there are adjustments throughout the term, they understand them, they're fairly done, and we're doing our due diligence in terms of setting appropriate expectations and assisting the customer throughout the term of the contract. With fix or not to fix with these components, passing through different costs could work to the customer's benefit, or it could work to their detriment. Every customer is different in terms of their preferences, their risk tolerance, and what's going on with their individual local market dynamics. So going through all of that and figuring out, okay, what is the context here? What does the customer need? And what is our recommendation given those pieces is something that, like I said, we really enjoy doing. We love helping customers through this process. It can be confusing, and we know that, but we're happy to lend our expertise and our relationships to making sense of this and helping the customer find a good match, both in terms of product, supplier, and partnership. Further, we can analyze, make recommendations, and negotiate specific contract language. We actually have negotiated custom contract language with several suppliers, where if we're pricing a custom opportunity and we request a contract, that language is different than what they give to everybody else, because we have negotiated on behalf of all of our customers, not just individual one-to-one, asking for the same change over and over again. So if that's something that would help your customers, if that type of contract consultation and product consultation, this type of holistic energy management, and this is just on supply, if that would be something that your customer is interested in, or something that's helpful to you as their energy consultant, that's something that we're absolutely happy to do. Scott, I think that's the end of my slides. Do you have anything you want to add on this?
No, you covered so much. I do have a few things though, Ellie. Appreciate it. One is that the strategies, we can do very sophisticated strategies for our large gas customers as well. It's not just power. Secondly, most supplier contracts, they say, if you ask them for give me a fixed price all in, so everything's just included. Those are most suppliers, those are subject to adjustments based off of a change in law, of course, which everybody has, but also where the tariffs are at. For instance, PJM, there's capacity billing out through June of 25 right now, or May of 25. That's next year. So you have a 3-year contract right now, and it's starting right now. You got 2 years. You don't know what the capacity costs are. What do you think is going to happen if those prices go up? They're going to pass on adjustments to you. They can't hedge that. Some can, some will. We know the suppliers that can. I mean, it's going to be a higher price than what some other supplier is, but that's why it's always important to have the apples-to-apples comparison. And why often the best price is not the lowest price, because you don't know what's included, what's going to be passed through. Even they're saying it's fixed, there might be losses, might be grossed up, it might not be included in that price and somebody else will. And why, dealing with experts on our desk, like we have our strategic solutions team here, we can really help you cut through all that and help you if you have competition on it, really help kind of dissect the competition's contract, put doubt in the customer's mind when there should be. When you're looking at one price and you're showing 3 or 4 and, oh, that price is lower, but who knows what's in that contract and what you have in yours and what the customer really needs and really wants. And that's really a great way to make the case to be a letter of exclusivity and LOE. And because now you can compare all of them at once. That's how you make the case. That's how you guarantee to get the deal done. And that's where we can do our job the best to really bring the best solution to the customer, which is really our passion, which what we want to do. That's all. That's all I got there. Any questions from everybody? I see one here. That's what's the kind of the size differences between the say medium and a large for these kind of hedging strategies?
So for the medium hedging strategy, that's the really simple, fixed float, still load following. Those are going to be customers that are basically 1 million kilowatt hours a year up to about 5 million, maybe just 4. But customers over that 5 million a year threshold are considered large, and they would be the ones who would have super sophisticated options available to them. We may be able to do something for customers that are even under 1 million, just depending on where they're located. So if this is something that you're interested in, where you have a customer, maybe they're not quite 1 million, maybe they're just 800,000, it's something that's worth taking a look at.
Good. Question here: what is the best approach to the customer to get a copy of their monthly bill? I'll answer that one. Yeah, I think you really, just ask. And tell them that it's really necessary to be able to do a proper analysis of what they're currently at, to be able to get them pricing. And certainly they really give pushback on it. A couple things. One is you're not going to win all the customers, right? So they're giving them amazing pushback. Imagine what they're going to do when you just try to get them to sign a contract, right? So make sure you're spending the time appropriately to the size of the customer and what that's going to entail. Number 2 is just tell them, like, really all you can do with a copy of their bill is pay their bill for them. That's the worst thing that could happen, and that's not a bad thing for them. I'm just saying, really is not information on there that can get access to their credit card information, credit information. There's not really much you can do with it other than just pay their bill for them. So you can remind them of that. Let's see, next question. What do you call the product where it's locked in the mid-season?
Product that's locked in only mid-season would be a seasonal hedge. Yeah.
Yeah. Mm-hmm. Yeah. A second here, I'm trying to got some more questions coming in here. Try to get these bigger so I can see them all. 1 second. Sorry. If we miss your question, we will. We usually follow up with them too. And for some reason, my thing isn't getting bigger to be able to see the questions. Can you see those questions, Eli? Oh, I see one. Will the suppliers have predetermined margin on these variable index products? Or will that still be between us internal? What they'll have is always will be if there's at the start of the contract, if it's not 100% fixed, there's going to be in what's called an adder, and that adder is going to be for all usage. And within that adder will typically be the margin, as well as bundling in certain things that you want to kind of get fixed. For instance, ancillary costs, maybe losses, maybe capacity, transmission, things like that. It depends. So yeah, but there is usually, the margin is usually predetermined, and you put it in there. And then what we do is, if there's subsequent hedges, is we built some models here, where we mimic where the pricing should come in at. So we'll make sure that the subsequent hedges, there is an extra margin being added onto that from there. Hopefully that answered that question. And yeah, I'm gonna figure out how to manage this. Once I get their bill, what is the sales process? Yeah, that's a much bigger subject line. Talk to your accounting executive, and we can work with you on that for sure.
And check out our YouTube channel. I think we've done a commercial energy 101.
Others on that, yeah.
Mhm.
Basically, I will say this though, is I'm big in the consultative sales approach. So don't just get the bill and come back with pricing for them. You got to ask the questions, figure out what they really need, build the trust, build the relationship out, and all that. And then let's see here. When is the auction, boxes auction platform going to be available? Great question. Yeah, we're still targeting here in Q3. It's in development stage, and it's moving along. In development stage means the coding's going on, everything's being built out on it. This isn't just something on the blueprints. It's actually being built right now. So we're excited to have that in Q3. We'll have a whole webinar discussing that, by the way. I noticed gas historically appears to be at a low, yet electric prices are on the rise. Thought right now, isn't there usually a correlation? See, okay, let's go through the questions and I'll answer that one, and that'll be the last one we'll answer. Yeah, so beginning of the slide deck, I talked about that. Yes, there's a correlation is out this year, and it all started out in PJM. PJM kicked off fireworks with that, with their big load forecast increase. And we've had some charts on this before. We have them now still. But anyways, the PJM kicked off with where load's been stagnant, peak demand load, and it's skyrocketed in their forecast up to 2030. And that sent off prices way out. That's just called a heat rate expansion, when the price of power increases more than the price of gas, by the way. And ERCOT, same thing happened here. And it was a little bit of rumblings of it starting to happen. And then bam, ERCOT comes out with a forecast increasing by 40 gigawatts, huge amount, almost half of what the current load is, increase of what the 2030 forecast was compared to what the 2030 forecast was 6 months ago. So with that, power prices have skyrocketed in ERCOT. And this is kind of a summary beginning of it, deck, but we here believe, as in PJM is starting to show, people got overextended a little bit. I don't think this load forecast is going to hit as high as it is. I think there's going to be efficiency gains, but the market is the market. You should always have a strategy going on. If you have exposure out in for instance, you shouldn't be on index coming this summer. I would not have that. That's for sure. But if you have exposure still in 27, 28, 29, and the load's not big enough yet, or even 26 and beyond, the load's not big enough to do a kind of a disciplined, like a hedge strategy where you can do partial hedges and all that, as we just discussed and Allie discussed on some of the products. I would hold off. I would actually just hold off, maybe a few months here, if I were you, to do that. But if you can do a hedge strategy, I'd always be hedging something out, and always have some partial hedge on out 4 years in advance. That's always our plan and our goals with our larger customers. Hopefully that answered the questions. Great questions here. But that's, I believe, it. And if we didn't get your question answered, we will answer them personally over email. But that's it. Have a great productive month, everybody. We'll be talking to you next month. We'll get the webinar details up here within the next week or two. And also, send over topics. Send some topics you'd like to see. we're always looking for some fresh topics to talk about. All right, have a great day, everybody. Just want to end this with this. Of course, we are, we're here to serve you. This is our team here. We are dedicated and want to work for you guys and really help you guys grow to be the best broker consultants and profitable broker consultants out there serving the customers. And we're here to serve you to do that. All right, take care, everybody. Have a great day. Bye.
Thanks, everybody.
Thanks for joining.